understanding Canada's taxation system can be overwhelming, especially when it comes to trusts and estates. However, being informed about the taxation of trusts and estates is crucial for effective estate planning and navigation in the event of a loved one's passing. Make sense of the intricacies of trust and estate taxation by diving into this comprehensive guide on the topic. A trust is a legal arrangement where a person, known as the settlor, transfers property to another person, called the trustee, who then manages the property for the benefit of a third party, namely the beneficiary. Trusts are typically set up for tax planning, estate planning, asset protection, or a combination of these reasons. In Canada, there are two main types of trusts: inter vivos, living, trusts, and testamentary trusts. Inter vivos trusts are created and take effect during the settlor's lifetime, while testamentary trusts are established by a will after the death of the settlor. Each type of trust is treated differently in the Canadian tax system, which we will further explore. For tax purposes, living trusts are deemed to be a separate taxable entity. As a result, they are required to file a T3 trust return, reporting their income and claiming any allowable deductions. The trust's taxable income is determined based on the same rules applicable to individuals, and the trust is subject to tax at its respective marginal tax rate. Any distributions made to beneficiaries from a living trust are considered taxable income for the recipients, and are subject to additional tax depending on their personal tax situation. The trust is entitled to deduct the amount of the distribution from its taxable income, thereby avoiding double taxation. Testamentary trusts also function as separate taxable entities and are required to file a T3 trust return. The main difference between these trusts and living trusts lies in their tax rates. Prior to 2016, testamentary trusts were taxed at graduated marginal rates, similar to individual taxpayers. Since January 1, 2016, testamentary trusts, with some exceptions, are subject to a flat top marginal tax rate, which in most cases leads to a higher tax liability. Similar to living trusts, any distributions made to beneficiaries are taxed in the hands of the recipients, and the trust can deduct these amounts from its taxable income. Testamentary trusts can also access preferential tax treatments, such as the principal residence exemption, if certain conditions are met. When a person dies, they are deemed to have disposed of their property at fair market value, leading to an 8216 deemed disposition. This may result in capital gains or losses, which are reported on the deceased's final tax return, also known as the terminal return. The estate is considered a testamentary trust for tax purposes and is subject to a separate T3 trust return. Probate fees, which vary by province, may also apply to assets passing through the deceased's estate. Probate is the legal process of having a will validated, and the associated fees are based on the value of the estate. Effective estate planning can help reduce these fees by strategically passing assets outside the estate, e.g., joint ownership or beneficiary designations. Estate planning strategies, such as transferring assets to beneficiaries before death, setting up living trusts, or using insurance products, can help minimize taxes on trusts and estates. Each situation is unique, so it's important to consult with a tax advisor, estate planner, or lawyer to determine the most effective tax and estate plan for your specific circumstances. Although taxation of trusts and estates in Canada is a complex topic, understanding the basics and engaging in effective planning can save you and your loved ones significant time, money, and stress. Therefore, being equipped with this knowledge is pertinent to making informed decisions and ensuring your loved ones are taken care of after your passing.